Tim, how we doing?
Well, thank you. Good to see you guys. How are you? I'm I'm a little bit, Dennis was doing the dance. This is what we were doing the last 3 days at Winter Wondergrass here in Steamboat. So I'm a little hoarse from screaming and shouting enthusiastically for the Kitchen Dwellers, Yonder Mountain String Band, uh, the Wood Brothers, just some
Holy,
some great music outside in sub-zero temperatures here in
Great.
Steamboat Springs.
I want Tim's life. He lives it up, man. He's got the dream. I got to below zero temperatures. I'd listen to some nice music here, but nobody's coming up to Georgian Bay anytime soon. So
There's not a Winter Wondergrass, Georgia Bay.
no, unfortunately,
Ah,
no. We used to have some type of winter thing up here, but with COVID, I think it all got canceled. Remember,
yeah.
Ontario's still in COVID. Rest of the world's over
Oh,
with, but Ontario hasn't got rid of it yet.
Oh, that's too bad.
Tim,
Well,
Tim, Tim. What? Tell us what the market structure. I was reading a little bit over the weekend and this morning just about
yep.
lack of liquidity in the markets, what that's doing for volatility. Give us your perspective on that.
Well, we talked about that a little bit
We
last
did.
Tuesday, I think,
Yep.
didn't we,
A little
Spencer?
bit. Yeah.
I noted that the average trade size in the S&P 500, so this is the number of shares traded each time a trade occurs, was 100 shares, which is exactly the regulatory minimum to make a bid or offer, to quote. And and yet at the same time, the average number of trades in a the typical component of the S&P 500, realizing it will be skewed by some of the larger components, was 50,000 trades. It went up from 40 to 50,000 trades last week in the 5-day average. So that's an astonishing number. And it
Could you say
tells
that
us
again, Tim? Could you explain that again, please?
Sure, yeah. So pick a component of the S&P 500. How many times a day does it trade?
Okay.
Well, the 20-day average is 40,000 times a day. The 5-day average was 50,000. So that's an increase of more than 20%, whatever that number is, 24%, I think. So 24% increase in the amount of activity at the same time that the trade size dropped from 109 shares to 100 shares. So that's an indication of a lack of liquidity, Spencer. What that means is that you have to do a whole lot more stuff to accomplish what you could before. And it tells us that the amount of shares that are readily available to buy or sell is really very, very small.
Yeah.
And that's a liquidity problem. So then if there's volatility, you get massive moves in the market. That's how the market goes up and down in extremes, like we saw Thursday, Friday. Then as soon as we came out of the options expirations period, remember, we talked about this too Tuesday. I said, generally speaking, no matter what is occurring on the planet, that if stocks are down into options expirations, they will be up afterward. That is the central tendency. And it proved to be true, even though Russia invaded Ukraine and the Fed reaffirmed that it's focused on raising interest rates. Well, back up 3 weeks ago, and there was all this hand wringing about, well, the markets are very concerned about hiking rates. Well, then why did the Dow go up 830 points? Best day since 2020. Well, there's your answer, Spencer. Liquidity, the absence of liquidity, combined with the presence of machines that change prices, and third, getting past the expirations period where the uncertainties are removed and machines lifted the market sharply, and human beings who don't want to miss out on the bottom followed them. But then what do you have today? Well, I'm not saying that we're going to give it all back. I can tell you that in the S&P 500, again, another data point, we love data, 49% of all trading volume is currently short, borrowed. And so for half the volume to be manufactured or used temporarily creates an environment where it's very difficult for the market to hold its gains. If the buying ceases, the presence of a lot of artificial liquidity in the market will push it down, particularly when the trade size is very small. So other than that, everything's fine.
Huh. And I mean, this is what you're talking about with liquidity. This is the market makers backing off the quotes. This is what they do in times of stress. It's called,
Yep.
if you want to go with, it's called adverse selection risk, where, you got a market maker that's sitting there with the bid and the offer, and they're basically in this environment, the bulldozer just got a lot bigger, so they're backing off the quotes. They don't get
Backing
run over
away.
by the bulldozer. I mean, when you look at the markets, and right
Exactly.
now it's absolutely, I was actually talking about this even after hours. I have not seen this, Tim. Maybe did we talk about this 2 weeks ago? The S&P being wider than it
Yes.
normally is. So SPY versus the futures. The SPY algorithm that is trading after hours is usually trading in a 3-cent range, 3-cent spread. They've backed it off to 7 or 8 cents, and I can see it, which is incredible. I haven't seen that in years, where you actually have the algorithm that's doing the futures S&P ARB backing off too. Like the futures is the most liquid vehicle, and the SPY is very liquid that tracks it. So for that algorithm that's running that to back off a little bit too is telling you that the adverse selection risk is high here. They're getting picked off at 3 cents, so they're backing off to 7 or 8 cents to keep making money. Because that's what you do if you're running an algorithmic market making system. And Joel, you were a market maker. And I've run small cap money market algorithmic systems. For years I ran them in the early 2000s. You start losing money, you're backing off a little bit. Okay, we're too tight. We got to back off a little bit, and that reduces the liquidity that Tim's seeing.
And that's not a change of 3 or 4 cents. It's a change. It's 120% increase in the spread. That's what it is. That's an extraordinary increase in risk for folks who don't actually want to own something. Market makers are hoping not to own anything at the end of the day. So you can make a lot of money on those spreads, but it also means you want to be out for sure by the end of the day. So it creates additional risk, no question. By the way, in SPY, short volume is 64%. 64% of the trading volume is short. That tells you it's an arbitrage trade. That's what it is. You can very easily go short SPY and long a basket, and then it goes back. Well, what does that create in the market? It creates an absence of capacity for the market to sustain its gains. You get some big moves, and then the market gives them back. That's a challenging environment for traders.
Dennis, you've given a lot of great information on this show over the years, but that stat that you just gave,
well, no, just my observations, not even
no,
a stat.
no, it's not a stat. Yeah, your observation. I mean, to me, that is the most. Yeah, that is.
It was actually another trader, Rob Friesen. Rob, and I was talking with him on the phone about it last week, and he was seeing the same thing. And I'm like, have you seen that before? I'm like, have you seen the SPY quote back off like that on the futures ARB? And I'm like, it's been a long time. I probably have to go back to thinking about it. Like you don't remember maybe, but probably going back to the financial crisis. It's been a good decade before I saw an SPY futures ARB bought back off a bit.
COVID.
No, I didn't see it then. Maybe.
Really?
Well, maybe it was so crazy then, Joel. Though we got so and it's it was crazy. We were down 2,000 points one day. I mean, that was a crazy environment. So I'm sure it probably did it then too. But it's telling you the risk is elevated right now.
And I just want to make just one, Tim, I'll let you go. Sorry. I just want to make one comment about that for traders and, whether you're new or active. I mean, it's more risk, but that does create opportunity. I mean, you put your order, don't hesitate. Put your orders out. If you have a target in something, like somehow if Disney goes back to 150 today, I mean, have your order out there at 149.90 because it's going to get taken. They're looking for liquidity. So if you have your points, man, don't market it. Don't say, "Oh, I'm going to do better than that price." Say, "Hey, stick it out there, do it because you're going to get done for better or for worse."
Yeah, and from a perspective where one can observe where your trades occur, and adjunct to that point, Joel. I as I've mentioned before, I pay a small commission so I can see where my trades occur. When they're being executed in dark pools, including my own broker's dark pool, I know that there is more demand out there. When my trades make it to the NYSE, I know I'm in trouble because that's where you go. That's where orders go to get picked off, to get adversely selected. So yeah,
that's the truth. When you start seeing the volumes, and this always happens, the off-exchange volumes start dropping with increased volatility because too much toxic, we send those orders away because there's a lot of risk
Don't
happening.
want that one.
I don't want that one. I don't want that one either.
Well, I don't know if we're helping anybody here who's hoping to figure out, where's the money
Yeah.
going. It's what do you do in this environment?
Right, boy.
Good question. We should ask you that. What do you do, Tim?
Yeah, Tim.
Where's
What is
the money going?
what is your playbook for this environment?
Well, as ever, it's diverging supply and demand, particularly where demand, the way we look at this, a 10-point scale, is 5 or better. I want to own things with demand at 5 or more, meaning there's excess demand and diverging supply. So I could give you a couple of examples, and they're not sexy stocks. Pepsi and Progressive, PEP, PGR. These are two examples of stocks that have the kind of market structure. I think of that as the behavior of money behind price and volume in context of rules, and those things will cause stocks to go up or down, and you want those things to be as favorable as possible for you. I could look at the FANGs and say, well, they're bottomed, and there's been an enormous amount of short covering in the FANGs, but I can't profile returns to save my life in that group. And if you can't mathematically establish that there's a probability of gains, then the math is telling you be very careful. I'm not saying that you can't, get a gain in Apple or this thing or that thing. I'm saying that that's not where the money's going. Right now, the money continues to manifest a very cautious posture, which shows up in how appealing the supply-demand equation is in Pepsi or Progressive. And we could look at, a number of others like that. Here, I'll share my screen. By the way, you can tell I got some sun too. We were out snowshoeing, and it was just a perfect day. But we got a pretty good tan at the end of February as a result of that. Okay, here we
Living the dream.
What a life.
He's living the dream. He's always living the dream, man.
It's so here's how I look at Pepsi. And again, this is supply demand. Traders, you can do this too. MarketStructureEdge.com. You could name an email. You can try this. Try it for a couple of weeks and see if you can follow how we think about this. It's a very simple way to think about the market. All economies establish prices through the nexus of supply and demand. All commercial activity somewhere arrives there. There can be things that distort those outcomes, and the market has those too. Options expirations are one of those. Today, index futures expire. It's part of the reason that the market is down. It's not that people are rethinking the risk in Ukraine. This is a product of huge moves in the market that create liabilities for counterparties, the parties who sold those and who have an obligation to fulfill them. And so you're going to see volatility today. It's very important to know. Another rule, new month, new money. So tomorrow, there's going to be money coming into the market in all probability, and it will go places. But so here, look at this. There are just 3 things to know. This is PEP's price. This is Pepsi's price, 30-day view. This is the supply-demand equation. Notice how it stayed right at 5, so you don't get a whole lot of price movement. What will then cause the price to go up and down is the third input here, which is supply, short volume. So if demand stays level but supply rises, what will the price do? It will go down. You don't want to own it when demand is below 5. Now, demand is rising again and supply is falling right into a new month. That tells me that there's a probability that low volatility money wants stuff like Pepsi. Okay, well, let's follow that, right? We just want to follow the money. And the same thing can be seen in PGR, Progressive, with the hilarious television commercial advertising. But here again, we can see the same condition. Generally, it's a 5. When supply rises, the price falls. And you don't want to own it when demand is below 5. Now demand is reverting to 5 and supply is below the trend, below even 40%, well below what's occurring in the broad market. Well, once again, that tells me that from an options and futures standpoint, that the large institutional money, index funds, quants, they're long. That doesn't mean the price is going to soar, but it tells you that there's a very high likelihood that these things outperform the broad market. And if we can always outperform the market, and you just keep taking gains and not chances, you can make good returns. So that's what we look at. Those are the things I would offer, Spencer.
Awesome. Tim Quast, Market Structure Edge, link on the screen, a link also in the description, marketstructureedge.com. Tim, always a pleasure. Have a good rest.
Always a pleasure to see you guys. Have a great week.
Tim.
Thank you.